This is Investing Ideas by ValueInvestAsia.com.
Hi, this is Stanley, and welcome to another episode of Investing Ideas. This week, our guest is none other than Ian Tai, our core contributor here at ValueInvestAsia.com. Ian is also the founder of BursaKing.com, where he shares a lot about what he knows about the Bursa Malaysia market. Ian also invests very regularly in the Singapore market, and he called himself a dividend investor. So he seeks out stocks and companies with very strong cash flow and stable dividend. So this week, he's going to share with us one such idea. And I'm very sure that you guys will find this company very interesting and definitely worth for you guys to add it into your watch list. So without further ado, let's get started.
From ValueInvestAsia.com, this is Investing Ideas, where we talk to investors from all walks of life, learn from them, and find out some of their favorite investment ideas.
Welcome to another episode of Investing Ideas. This week we have Ian. Hello, Ian. How are you?
Hey, hi Stan, how are you?
Yeah, I think our audience are quite familiar with you, given that you are a regular contributor to us at Value Invest Asia. But before we dive straight into your investment ideas, which is a very interesting one, why don't you just share a little bit about yourself and explain your core investment strategy? What is it, and how do you define yourself as an investor?
Okay, sure. And before I do that, first and foremost, thank you so much, Stanley, for having me on the show.
No problem.
And it's a pleasure to not only just speak in your events and as well as to write a bunch of articles in Value Invest Asia. So that is actually one of the key things that kept me busy, which is to write quality articles to Value Invest Asia. But of course, I do a whole bunch of writing to kclau.com, which is a personal finance website in Malaysia, and as well as, of course, perhaps your competitor or your peers like the Fifth Person, and as well as Small Cap Asia.
Okay.
All right. So in terms of my investment style, I'm pretty simple. I like to keep things really, really simple. So I'm a dividend investor. All right, and I primarily invest for dividend income. So that is my main focus. So currently I've built a portfolio where 80% of my portfolio consists of SGX stocks. So
okay.
all right. So perhaps I mean to say, if you are a Singaporean, perhaps this may not be anything, but just to give you how I say a more background into it, I'm a Malaysian. So so for those of you who are listening and you're from Malaysia, so I'm a Malaysian who invests quite a lot in Singapore stocks. And currently my portfolio, I have calculated my dividend yield. On average, it's about 6+% per annum. And I do
Nice.
collect dividend income every now and then. So if every year we have like 12 months, I will collect dividend, practically speaking, around 8 to 9 months in that 12 months. Yeah.
Okay. So you don't even need to work.
Still need to work to build up my dividend income. But at least to say this dividend income, they pay some of my bills So I
Nice.
find they are quite helpful as I'm speaking right now.
Yeah,
Of
cool.
course, that is the surface part of what I do and what I aim for when I invest. But if you dive a little bit deeper, I have a system to building that kind of portfolio. So, like for example, my primary aim, of course, is to increase dividend income. So naturally, I will go with stocks that not only pay dividends, but they have to pay growing dividends on a consistent basis.
Okay.
And of course, since I'm into dividend investing, of course, I would like to buy all of these stocks at the cheapest possible price. So valuation ratios like PE ratio, PB ratio, and dividend yields are my favorite kind of ratios to assess whether or not it's a good time to buy.
Wow. Okay.
Yeah.
So you say that you are a dividend-based investor. Does that mean that you completely don't have any stock that don't pay a dividend?
No, all my stocks pay dividend.
Wow. Okay. Cool. And today you're gonna share with us another dividend stock also. One that, to be honest, caught me by surprise when you suggested this stock. So why don't you go ahead and introduce it, and tell us a little bit about this stock. What is this stock about?
Okay, so the stock is about, so this time my pick is on Cromwell European REIT. So this is my stock. And of course, we have the SGX symbol, which is CXFU.
Okay. So
And
listed in Singapore.
yeah, so it's once again listed in Singapore.
Okay.
And Cromwell, so I'll just briefly use it as Cromwell. So if you talk about Cromwell, it's Cromwell European REIT. It is actually a diversified REIT with a wide range of portfolio, wide range of assets. Like for example, we have office properties, light industrial warehouses, logistics properties, and as well as retail assets. So all of these assets are based in Europe,
Okay.
in 7 countries, namely in Holland, Italy, and France. So Cromwell European REIT has a very good sponsor, and the sponsor is Cromwell Property Group, which is an Australian listed real estate conglomerate. So later I will get into that.
Right.
And currently, as I speak, um, it is in the midst of acquiring another 6 more properties. And when that happens, it will have 102 properties in its portfolio, valued at 2.07 billion euros.
Wow.
So that's the brief intro of Cromwell European REIT.
Okay, so definitely not a small REIT. But you mentioned the sponsor Cromwell Property Group listed in Australia. So this is an Australian property company, but the REIT is only in European asset. Is that right?
Correct. So if I may just jump straight into the sponsor. So I'll just give you a little bit of background of who Cromwell is, and
Okay.
maybe we can understand the relationship a little bit better. So Cromwell, what I've gathered is this: Cromwell Property Group is a listed company in Australia. So, and but then it has assets globally, mainly in Australia, New Zealand, and as well as Europe. All right. So currently it has it's 270 plus properties, and which is worth about 7.5 euros, or if you want to convert it into Australian dollars, is about 11.9 billion dollars, and that's its property portfolio. Huge customer base of 3,000 tenants, and currently Cromwell Property Group owns about 35.65% of Cromwell European REIT. So what they do is that the sponsor, which is Cromwell Property Group, actually they form the REIT, which is Cromwell European REIT, to hold all the European assets, or at least bulk of its European assets in the REIT. Yeah.
Right. Okay. And so far you say they are a diversified REIT. What does that really mean? Do you have the big breakdown of where are their property located geographically, number one, and also the type of asset that they have, the breakdown of the type of asset they have?
Okay, so let me just go through with you the geographical breakdown. All right. So it has properties in 7 countries. All of them are based in Europe currently.
Okay.
But I will give you the top 3 because that's more memorable. So the first one is in Holland, or the Netherlands.
Okay.
So in the Netherlands, it has around 17 properties, and the portfolio valuation, as I speak, is $627 million.
Okay.
627 million euros,
Okay.
which accounts for 30.4% of the total valuation of the portfolio.
Okay.
Okay, so that's Holland. In rank number 2, we have Italy, where it also have 17 properties, worth around 459 million euros, and which accounts for 22.2% of the total portfolio valuation. And the third one, all right, the third one is France. It has about 27 properties. Although it has larger amount of quantities in terms of properties, but the portfolio valuation is 421 million euros, but it still accounts for 20% of the total portfolio valuation. So if you add it up, Holland, Italy, and France, it has around 72
Okay.
or 73% of the total portfolio valuation. And the remaining countries, which includes Denmark, Germany, Finland, and Poland, so they will make up the final 27% of the portfolio valuation, which is around 558 million, and that's about 41 properties. So that's the geographical breakdown for Cromwell European REIT.
Wow. Okay. So actually, from what you say, is actually quite diversified.
Yep.
Just listening to you talking about how many property that they own and across so many countries, I feel safe already. But on the other hand, how do they match up with the asset classes? You say they have offices, light industry, logistic, and even retail. So do you have the breakdown for that?
Okay, so currently I may not have the breakdown for that, all right, because I thought this will be a very brief and very sweet
No, no,
session.
no. You thought wrong. You thought wrong. I'll deep. I'll dive very deep with you on this one. Yeah, but
Okay,
just
so
from the top of your head, do you remember like which is the main asset class that they are focusing on?
how about we skip that for now? I will talk through that with you shortly as I download its annual report and stuff like that.
Okay, okay, yeah.
All
Let's
right,
jump
let's
to tenant mix first, right? You mentioned that they have so many properties, and actually a lot of them they are tenanted, so they have many tenants as well.
mhm.
From your own observation, do you like the tenant mix and the tenant concentration? Do you see any issue there?
Okay, so in terms of tenant concentration, so let me just give you a breakdown. First and foremost, Cromwell European REIT has a large customer base. It derives income from 911 tenants, so it's about 1,000 tenants. Okay, currently the portfolio occupancy rate is 91.6%, which is quite healthy. And most of these leases they are quite long term with built-in rental escalation. And currently, overall, in terms of its portfolio, its weighted average lease of expiry or WALE is 4.9 years, so which is a very, very long time. 75% of its leases will begin to expire only in financial year 2022, which means to say that's pretty good. Considering that right now we are 2019, so which means for the next 2 or 3 years, we can expect to see income visibility, or we can say that the income from all these leases will continue for at least the next 3 years. Pretty good. Now, in terms of its tenant breakdown, so what I have here is that in terms of its trade sector, all right, if you look, what I've gathered is this: it is pretty much diversified. It's not concentrated on any single but or any particular industry, because it is quite well spread towards government sectors, which is known as public administration. We have financial services. We have people in the science industry, transportation, administration, construction, retail, manufacturing, IT, and entertainment, and so on and so forth. So it is not exactly quite biased towards any certain kind of industry, which is quite diversified. And of course, when it comes to its top 10 tenants, 37% of its top 10 tenants, I know what I mean to say, the top 10 tenants actually account for 37% of the total headline rent of European Cromwell REIT. And most of them are actually, if you can, the most of them are actually from the government sector, um, especially the first one, which is from Italy. We have the Agenzia del Demanio, which is the Italian State Property Office. So they account for 15% of the total rent,
Wow.
total headline rent of European Cromwell REIT.
Okay.
So that's the tenant breakdown.
Okay. So essentially, you are betting on the Italian government for this
Uh,
REIT.
sort of lah.
Okay. Yeah. I guess the tenant mix is very strong and everything. From your investigation, are you able to see what's the typical rental contract that they have? We see a lot of overseas REITs in Singapore where they have rental reversion according to say the CPI numbers or anything, do they have like such a step up mechanism for their typical rental agreement?
In a way, yes. They most of them have, all right, in terms, and they are basically indexed to the inflation, all right. So they are inflation adjusted, or we call it CPI lah. So it
Oh,
depends.
okay. But the
Yeah.
problem is Europe is not having much inflation. Some country might be also experiencing negative inflation. Does that mean the rent will go down? I caught you again.
All right. Hopefully not. All right. But I believe usually when it comes to a step up rent, right, it's not exactly like it's it's always like there's a downside protection whereby there's an initial base rent, so that
Okay.
is like the minimum thing, and then on a year basis, then only we add to its inflation. That's why it's called inflation adjusted lah. If it's negative, let's say -1% in inflation rate, which is a deflation, then I would suppose it will maintain the base rental rate for the following year. Yep.
Okay. Fair enough. I guess I sort of can see it from your point of view. Yeah. Why don't you share a little bit about their financial? Why do you like this REIT?
Okay. So in terms of its financial, first and foremost, it is actually pretty stable. Ever since listed, it has actually generated quite relatively a stable income. But I'm going to give you a snapshot of its latest 12 months financial results. So as you can see here, when it comes to the net property income, quarter three, quarter four, it's about $21 million. But then quarter one, quarter two, it has a step up. As you can see from quarter four 2018, net property income is about 21 million. Quarter one 2019, there is a step up of 6+ million euros. And quarter two 2019, net property income has again increased slightly to 27.7 euros. This is because in the course of let's say 2018 quarter four 2018 and to quarter one 2019, what happened was Cromwell European REIT has actually increased, all right, its property portfolio once again. It has actually completed a number of acquisitions, particularly in France and Poland. So this has actually contributed to the step up in net property income for the REIT. And this has actually translated into growth in terms of its distributable income, where the distributable income in quarter three, quarter four of 2018 is about 17 million. Quarter one, quarter two, 2019, it has increased to 22 million. So, which is very, very positive.
Right.
Of course,
Okay.
in terms, if I may continue on, it's a little bit about its distribution per unit. Quarter three, quarter four, it's about 1.08 cents. Quarter one, quarter two, 2019, it's 1.02 cents. So although there is a increase in distributable income, there is a marginal decline in distribution per unit, simply because Cromwell European REIT has actually exercised or undertaken a rights issue to acquire these properties, and therefore it has enlarged its unit holder base, and therefore that causes a slight drop in DPU. All right, but anyway,
Yeah, I'm just gonna stop you here. I'm just gonna
yep,
stop you here because I found something that I cannot resist, but I have to say.
yes,
Right.
of course,
You mentioned, yeah, it's growing very well, but we see that in many REITs. That's one of the key problem of a lot of REITs, which is that they grow their net property income, but because they are REITs and they don't have excess cash lying around, and when they make acquisition, they always have to have private placement or rights issue, and it end up diluting the existing shareholders, right? So even if their distribution income is increasing, but as a unit holder, my distribution per unit is actually dropping, as the size of this REIT is increasing. Don't you see that as a negative rather than a positive?
There's a mixed bag in terms of rights issue. All right. So for me, there are both sides to there are two sides to a coin. So if I were to say from the positive, from one angle, let's say we have Cromwell European REIT. Initially, it has that amount of properties. All right. Let's say around 90 plus properties. And finally, after having undertaken a rights issue, it has actually grown its portfolio to about 100 plus properties. All right. So in that sense, you can say that the income will be much more stable because instead of generating income from 90 over properties, now it has 100 over properties, more tenants. So it actually reduces the concentration risk of each property, each country, and as well as each tenant. All right, when it comes to its income generation. So I believe that in that way, it adds to the stability of the REIT. So that's the positive part. But of course, I do agree with you in terms of its negative because sometimes it may enlarge the unit holders, the base of the unit holders, or the number of units issued out to the market, and therefore it will cause a slight adjustments, and usually the adjustments are downwards towards the distribution per unit. So when it comes to this, of course, when we calculate our returns from our dividend use from this particular REIT, we have to exercise a little bit of caution, and we have to take into this. We have to take into this as a consideration. Yep.
Right. Okay. So, what I'm hearing from you is, yes, they would, they are decreasing their distribution per unit, but as a unit holder, you don't really mind because the whole REIT is sort of reducing in risk exposure because it's becoming more and more diversified and more stabilized lah. Is that fair to say? That's your point of view?
In a way, yeah, you can say that.
Okay. But okay, before we go, before we continue, as a disclaimer, you do own this REIT, right?
No,
Oh, you don't own this
not yet.
REIT. Okay, but this is something that you're already looking at.
I mean to say this is something that I believe that because it has the positive and as well as some form of negative. I believe that it's gonna be juicy enough for us to have a discussion lah. So that's why I choose this bit.
Right. Okay.
Yeah.
Okay. Yeah. Then since you already say that you don't own this REIT, I'm gonna press you even harder.
Okay.
What's holding you back right now, on this REIT and not investing in them?
All right. That's a very good point. I'm not too sure whether I should review this lah. All right.
No,
Especially
go
to the
ahead, review it.
well, because I'm actually considering a real estate in Malaysia. So because of that, I need cash for the down payment for the property.
Okay. So it's more of a personal reason rather than anything wrong with the REIT, right?
Yes,
So if you
exactly.
have all the capital in the world, this is definitely one that you don't mind investing in as well. You're saying?
I don't mind having a small position in this REIT if I have excess cash. Yeah.
Okay, sure. Before we go into the valuation part, right? I think a lot of people will be interested on how you value this REIT. Just before we go into that, why don't you share with us a little bit? What do you think is the most pressing risk with this REIT for an investor who's looking at Cromwell right now?
Okay, I would say that there are two. All right. The first one, of course, is the currency risk, because the unit price will be denominated in euros. The financial accounts will be reported in euro. And if let's say, for example, I'm investing from Singapore, I'm earning Sin dollar, I'm investing my Sin dollar into this REIT. I have to take note that the euro has been depreciating against the Sin dollar for quite some time right now. So that could, if you want to measure your returns in Singapore dollars, then of course you may want to take that into consideration. But since I'm a Malaysian and I'm using ringgit, of course, that actually differs. All right, the point of view may differ because from a Malaysian point of view, I believe that the euro is a far more reliable currency as compared to the ringgit. So maybe it's a chance that it's a chance maybe I will probably take. All right, and that is so. If let's say for example, if you're a Singaporean or you're investing your Sing dollars into um, Cromwell European REIT, then of course do take mind of this currency risk. Now the second thing which I think is more pressing to me is that for me I'm a dividend investor and I love to look at track record. I love to look at a stock's track record and I will assess it based on a 10-year basis, 5 to 10 years basis. But Cromwell European REIT is a relatively a new REIT because it was listed on November 2017. So in terms of its financial track record, it is shorter. It has a shorter track record as compared to other REITs. All right. So in that sense I may put a little bit of discount for this particular REIT because of its shorter track record. So
Okay,
these
okay,
things
fair
that,
enough.
yeah, that concerns.
Yeah, I guess it all links back to what we're gonna discuss right now, which is valuation, because everything has a price. If you say that there is all this risk, and if the possible return, the expected return from this REIT is high enough or attractive enough, then the investor might be willing to take on that risk. So why don't you share with us a little bit about how you value this REIT, and what's your opinion on the valuation right now?
Okay, so let's go back to, so if I were to recall back what I've said about distribution per unit, so Q3 2018 is 1.0, Q3 and Q4 2018 is 1.08. That was before the rights issue, and after it has exercised its rights issue, Q1 and Q2 2019, it has paid out 1.02 euro cents. So with that said, so in this sense, for me, I will actually ignore the 1.08. Rather, I will take the quarterly distribution, the latest quarterly distribution per unit of 1.02 euro cents as a basis of calculation. So if let's say I would take 1.02 euro cents, which is the latest 2 quarters, all right, and I will multiply by 4 quarters, I will get an annual distribution of 4.08 euro cents, all right, on a per annum basis. The current unit price is 51 cents. So if you take 4.08 and you divide by 51 euro cents, you will get 8.1% in terms of its gross distribution yield per annum. All right. So let's keep that in mind, 8.1%. So in terms of its PB ratio, 51 cents current unit price. Its net asset value per unit is 52.3 cents. So if we take 51 cents and if we divide it by 52.3, we'll have a PB ratio of 0.975. Basically, it's trading slightly below its book value. So these are the two valuation ratios that I can give to your audience currently.
Okay, and based on these two valuation, I guess ratio,
Yep.
you do feel that they are quite undervalued at the moment, or do you think that they're just fairly valued? Because you can say that the price to book is below 1, but sometimes that does not necessarily means that it's cheap, right? We've seen a lot of property companies, even listed in Singapore, like Hong Kong Land, or right now all the Hong Kong properties, they're trading like 0.2, 0.3 book value. But I wouldn't consider them as undervalued. So what do you think of the valuation right now?
Okay, so this one is a bit tricky because for me, I personally like to compare the current distribution yield and PB ratio with its past track record. But unfortunately for this REIT, we cannot compare it with its past averages. So therefore, we have to take another approach. All right. So if I'm the one investing, I will have to compare it with its peers. All right. So its immediate peers is actually iREIT Global REIT or iREIT Global.
Yep.
So that's another SGX listed REIT which invests in properties usually office towers, office buildings in Germany, but they only have five. They only have five office buildings in Germany. So if I want to compare iREIT Global with Cromwell, I'll still go with Cromwell. I've already calculated the iREIT Global in terms of its distribution yield. It's again about 8%. So if I were to compare Cromwell European REIT with iREIT Global, I'll still take Cromwell European REIT because of its large quantity of properties, and it is actually more active in terms of its acquisition of new properties. So in terms of that, I would still prefer Cromwell if I'm given a choice. But of course, if I were to compare it with other REITs that pay more than 6% in distribution yield, as I'm speaking right now, it could be it could be an SGX listed China-based property REIT. It could be something like BHG
retail, right?
All right, and maybe Capital Land Retail China or something like that. All right, and maybe EC World REIT and stuff
I
like
guess
that.
it's totally different. Why you would want to invest in, say, a Capital China Retail Trust compared to the Cromwell REIT, right?
Of course, I'm extrapolating it a little bit further because the common ground between the two is the distribution yield. It's not exactly the geographical location of these properties. But in terms of its distribution yield, let's say Cromwell is paying around 8%, and let's say EC World is paying around 7%. I'll still go with Cromwell because most of its properties are freehold. And even if they are leasehold, they are like perpetual kind of leasehold kind of properties.
Right.
Whereas if I were to choose a China REIT or China-based REIT, they are predominantly leasehold properties, and their leasehold are usually below 50 years.
Yes.
Yep.
Yeah,
So
definitely.
still go with a European REIT. Yep.
Okay. Oh, wow. Cool. Yeah, I think you share a lot today. From what I heard, it's definitely a very diversified REIT with quite high quality asset, all around Europe, and both tenants, both geographical breakdown, they're all quite diversified. But as an investor, we do have to take on the currency risk. And also, if they are continuously building up the REIT, there will be some dilution risk for us as well, right? Would you agree with that?
Yes.
Okay, cool. So I guess, do you have anything to add before we go, Ian?
I believe that what we have discussed is quite a lot already about Cromwell REIT, and of course the addition depends on you, Stanley, whether or not you still want to exclude this REIT or not.
No. I think we cover most of the bases. And I think you have convinced me that this is a viable option for investors looking to diversify away from, say, if they already have a whole portfolio that is completely exposed to just one country like Malaysia or Singapore. This is a great stock for them to consider to diversify away and yet still own some quality asset as well. So definitely I am so on the idea. Once again, thank you so much, Ian Tai from boosterking.com. He's also one of our most regular contributor here at valueinvestasia.com. We'll definitely have him back again very soon. So thank you for your time, Ian. Hope to see you very, very soon.
All right. Thank you so much, Stanley. Hope that you guys have benefited from it.
All right. Cheers.
All right. See you.
Thank you for listening. You can subscribe to our show on Apple Podcast, Google Podcast, Spotify, or wherever you get your podcast. If you are feeling generous, please give us a rating and review as well. This would greatly help other investors find out about our podcast. To access our show notes, please go to valueinvestasia.com/investing ideas, and be sure to sign up for our email newsletter for more outstanding content and reports about investing. The show is for entertainment purposes only and should not be taken as investment advice. Please seek professional advice or do your own research when making any investment decision.